Hey everybody, this is Kaylee McMahon. You know me, of course. Today we have a special guest, Shannon Shackerley-Bennett. She has quite a bit of knowledge to share with us today. So I'm going to let her introduce herself, and then we've got a couple of questions because we get to learn about hotel development and some other things today. So Shannon, go ahead and introduce yourself.
Thank you so much, Kaylee. So yeah, I'm Shannon Shackerley-Bennett, and I'm the owner and founder of Northstar Hotel Development, which is a sister company to Northstar Development. We generally focus in the hospitality space, and we focus on capital raise to acquire properties, and then I take them to the city and propose a new project that would go onto that land, generally hospitality projects, hotels for Hilton, Hyatt, Marriott. And once we get approvals, then we typically sell off to a builder. So it's a little bit like selling and flipping a home. It's just a lot more rooms.
Very cool. So you're the first guest that we've ever had on any of our platforms to talk about hotel development, which is really cool. I have known somebody in the past that was, I guess it's called a franchisee for Hilton. So I have heard about the concept before. I've never really learned about the land acquisition part of it, the financing part of it, and whatnot, but he seems to hold on to them for a long time. So obviously there's different models in hotel development in general, or being in hotels. Like I'm sure there's value add. I'm sure there's different, just like in multifamily and some other commercial real estate. But really what we're focusing today on is the pros and cons of investing as a limited partner and as an active sponsor in hotels. I was going to say multifamily. In hotels. Because that's what I do. But in hotels, because what we want to do is be able to teach women every different kind of cash flowing asset that they can either like invest in or invest with or start on their own, what to look out for and what are the pros.
Yeah, and actually you raise a really good point there. So just as my first reaction is hospitality is very unique because you have the land, the appreciable asset of a land that's appreciating over time and doesn't actually generate any income. You need to monetize that land. And then you've got the business. You've got the hotel that sits on top of that land. And those two aren't always owned by the same person. So sometimes hotels are sitting on land. I think 30% of hotels are on ground leases, and that creates an expense on your line item, which has obviously implications on cash flow. So, and then from there, where I want to take you to is the concept of investment. And when we look at cash flow investments, a lot of what I do actually doesn't flow cash very quickly, but actually has a return that in a lot of investors' minds is quite quick. So I will get into acquiring a property, and it generally takes me about a year to entitle it, to get those approvals for the new project. I'm going to give you an example because I always think examples can help people visualize. A site that we're working on right now in San Jose, we picked that up for $6.5 million. And the entitlement costs are going to be about $1 million. We're just under budget. We're almost through the process. So these figures are current, they're real. And so you can envision that we've now sunk $7.5 million into a project. Now, all the investors who came into this project a year ago, they haven't seen any cash flow because there's nothing there. There's no income, right? In fact, all it is expenses. And but what we're looking at is now as we come to approvals almost a year later, this becomes a very attractive piece of land for builders, those who want a land bank, those who want to actually be an end user, an owner-operator of a hotel. And that's who will buy this property from me. And we're expecting that appraisal to come in between $9.5 and $10 million, which is at a reduction because of where the hospitality industry is today with COVID and market pricing. So right there, you can see what the lift is. You can see what the value is. And to our investors that are invested in that project, they're forecasting out between 22 to 25% annualized returns. That's pretty healthy. But there's no cash flow, there's no monthly or quarterly distribution while they wait for that return. Now, on the flip side, I can take that same investor and say, look, if you want cash flow, then why don't you come with me to a property in Texas? And I know that I'm going to be picking that up for $4 million, and I'm probably going to be returning something like a 6% pref to you on a quarterly basis. Very different model. One is very unknown. There's a high degree of risk in entitling property and working with the public and the city and architects and vendor teams that may or may not perform. And even after you build it, you don't know that you've got a buyer. And those are the kind of things that investors need to be aware of and ask those pointed questions to the person who's presenting the offering about, I don't care about the entitlements. Tell me about how you're going to exit. How do you know that you've got a buyer for this property? It's no different than flipping that home. You can pretty it up and value add all you want, but if you don't have a buyer, you don't have profits. So again, it comes down to understanding, what kind of investor am I? Am I willing to take that risk as a passive investor? Because you are passive. You sit by and you watch those decisions being made. And you don't get to jump in there and say, hey, actually, I think that should be a Hilton, not a Hyatt. Those decision points are made by your management team and not by your passive investors.
Right. Now, you said a few terms while you were speaking that I think, because I don't know at what stage in the process people are listening to this. So just to define a few key terms, could you tell our audience what a pref is?
So a pref is a preferred return, and it really says that before anybody else gets any funds out of this, we're going to offer you an amount. And so every offering that we have a private placement memorandum. Within that private placement memorandum, you should be looking out for some key things that form that document. And it should be dense. It shouldn't be a one-pager. It should have the operating agreement for the company you're going to be investing in. It should have the pro forma, that document that tells you what the future value is going to be, what the cost is. It should have the use of funds, right? You're investing. What are they going to use the funds for? And how do you hold them accountable to using those funds? And then we get down to, in some models, for us, we use a subscription model so that investors purchase shares in my company. That's that limited partnership. They have limited ownership. They don't have any decision-making rights, but they are an owner in that company. And that subscription agreement will say, here's what you're investing in, here's the shares that you're buying, and they're this value, and because of that, you're expected to get this return. There's no guarantee, and you'll see that in the private placement memorandum, the document that goes with it. A PPM, a private placement memorandum, is designed to outline all the risks. What are the management risks, the project risks, the market risks, the COVID risks, any risk that you could possibly think about, you want to put in front of your investor in that document. It should be dense. You should be freaked out. And then by the time you finish reading that, if you still feel that you want to take the risk, then you go over to that subscription document that I talked about that subscribes you to the shares. And then you're going to see in there the terms, and those terms will say you're going to get a preferred rate of return for taking that risk. And here's what it's going to be. And, it really depends on what the project can bear. And you should see that reflected in the pro forma. If you have somebody who hasn't understood the market and is overpriced or overestimated what the exit value is going to be, then there will be not enough funds there to be able to return money back to you at that preferred rate. So although a subscription agreement may say, yep, you have a pref rate of 6%, the fact is if there's not sufficient profits in that project to return 6%, you're not going to see it. So I'm always asked by investors, well, not always any longer. I think we set the stage a lot more clearly now than I did when I started. And but in the beginning, I was always asked, what's the guarantee?
Right.
And there is no guarantee. Nope. This is a high risk investment, folks.
Yeah. So when you're talking about cash flow, what I wanted to ask about was the appreciation part of what you do. And I'm sure you've done hotel deals that have been structured differently. They're probably not all the same. To where, one is kind of what you're talking about, getting it developed, doing the entitlement, doing that part of it, and then finding an end user or an owner-operator to handle the property. Now, so obviously if you're finding an end user, well, you can correct me if I'm wrong. So I see that there may be some payout, some preferred return to the investors. When it comes to appreciation, how does that play into hotel development, hotel returns? Is that part of a benefit? Is there any, how does that work?
It's really, really complex, and every deal I've looked at, every deal I've structured has been different. And so what you need to look at is oftentimes, what I know is I've never seen a deal where there's just one person in it.
Yeah.
Right? Most will have at least 5 partners. The way that we structure it is generally we offer a 70-30 split. So we'll actually just look at straight equity. And a lot of our deals, we actually prefer equity over offering a pref because it's much safer. We're going to give up a lot more money, but we know that we haven't made a false promise or that there isn't an anticipation, and we managed expectations that way. So when I say I'm looking at a 70-30 split, what I do is I carve out the future value of that property, and I'm saying, and let's say it's just cash flow. Let's just say money coming in. Whatever's coming in, I'm going to say 30% I'm going to hold back for my company and the leadership of that company, and then the 70% goes to my passive investors, and it's split typically, but not always, but typically proportional based on the percentage interest that's applied on the number of shares that are purchased. So if it's $1 a share, it's straight math, right? And you've got 100 shares available and you buy one of them, you've got that 1%. And that means that of the 70% of the profits that come back, you're going to get 1% of that 7%. So there's some interesting math that flows through that helps show an effective percentage overall in the company, primarily for tax purposes. But you should be able to follow the math and understand how much your returns could be based on an assumption of a sales value or of a net operating income.
So
hopefully that's helpful, but they're so varied. I've seen so many now, but that's the most straightforward, simple version.
Sure. I thought I would ask because is there a such thing as, like, for example, exits, right? That's what I wanted to ask next. We talked a little bit briefly earlier about some exit options that, sometimes, like when I've done residential, sometimes I've done multifamily, depending on the market, depending on certain situations, you kind of have to pivot your plan that you had, and it's always good to have a couple of different options. Obviously, like I mentioned with single family, you've got your typical, okay, we're going to flip it and sell it. Well, we can't, so now we're going to long-term hold it. Is there a such thing where you'd get stuck in a situation like that in hotel development where you're like, okay, well, this is going to end up being a long-term hold play? Is that possible?
Yeah, that's possible. That's very feasible. We're in that situation right now. So, with COVID, as I said, if I don't have a buyer for a project, then I don't have any profits. And that's a hard conversation to have with investors. And it's one that we make easier we bring them along on the journey. So nobody gets a phone call from me 2 years later to say, hey, this didn't work out the way I thought we were going to exit. You're there coming to my weekly meetings if you want to. You're passive, so you have no obligation, but it's there. You're going to get a monthly report. It's passive. You don't have to read it, but it's there. And so, what came to us in probably March when COVID started to really kind of show itself, we were actively marketing a project. We were ready to sell it. And buyers just started going really quiet, super quiet. And we have a very solid pool of buyers, over 200 that are pre-qualified. And I don't mean I have their proof of funds. I mean, we know what their requirements are, that they've got the credentials, they've been certified by the brands to operate these assets. So these are individuals who are ready. And really what happened is they started to say, I'm going to hold cash. I don't know what's going on here. I need to be able to meet my current obligations before I can start a new project. And then this kind of started to change even more, which was, hey, I might be able to pick up distressed assets, which I could run and operate for less than it will cost me to build this new one. So we started to have that conversation with the investors on a weekly basis and say, we're contingency planning. And we know that, we identified 7 different options. And you're right, just like that home, can I get a JV partner? Can I get a JV partner who will take out my investors? Can I get a JV partner that will cover my debt servicing? Can I Can I get my investors to pitch in more and take out debt servicing so that I can get longer? The whole time you're having good conversations with your lender and making sure that you can get extensions, that you've got coverage, and that you're paying your current debt servicing. You want to look at other options. Do we land bank? Do we sell at a loss? These are all options that are very viable, but some of them are simply just not desirable. And so, you quickly say, and when you're having these conversations, your investors are really in a difficult situation because they don't get a vote. It isn't like they have a say. But I find our company, we value collaboration. And by bringing people along on the journey, there's a great deal of understanding. And there's also a great deal of goodwill that comes where, they have come to us with ideas and solutions that we would have never considered. So, yeah, I can get a loan on my home. I can take another mortgage. I can cover that debt. Great, but exactly, it was never an option that we would even have considered. So, what we ended up going with was a joint venture partner that would be able to exit our investors as we planned and help us move along. The ownership team, the leadership team will end up leaving equity in the deal and becoming an owner of an asset we didn't really intend to. But you meet your objectives, and I think that's business. If you need to manage what your work is,
right,
and be creative in your solutioning.
Yeah.
Can't say this has happened and throw your arms up in the air. It's very much about meeting your objectives and figuring out one way you can make that happen.
That's the cool thing about real estate, I think, is that, it's never a do or die. Like, okay, here's our plan, but you just pivot, that's all you can do. So that's...
Yeah, and I think having a really strong network of people that you can lean to that will help you pivot is important. Having general counsel that's been in business for a long time and that has people that they can reach out to and say, hey, I do know people that are creative. Having a tax, CPA, these are partners in our business that we rely on for guidance and advice, and also to be champions for us. So that's also really important. People often overlook those resources. And if you're an investor in a project, you probably want to ask that company, who are your resources? Who do you ask? Who's your mentorship team? Who's your advisors? If they don't have any, they're limiting their perspective.
Right. That's 100%. Like, even when we're doing, I have a slide deck coming up soon here. There's a slide just on, like, okay, here's our construction team that we use. Here's our legal team that we use. Here's our CPAs that we use. You find strength in the team,
Yeah.
And I think that, like you said, that kind of reduces risk. Now, speaking of reducing risk, when it comes to doing a development project, and then also as a owner-operator of a hotel, for us, when we're doing multifamily or apartment deals, for me, as long as there's adequate insurance, I feel a lot more comfortable and confident. Of course, having a great real estate attorney, a litigator, and then tons of insurance are the ways that I feel really comfortable, kind of moving forward with things that might have inherent risk. How does insurance kind of cover you? Or, what's a pro and con when it comes to development insurance, being a owner operator, holding it? Yeah, anything you can speak to on insurance.
Yeah, that's insurance in the hospitality industry and the development industry is really complex. And so we go beyond where we're actually working with two different groups that are specialists in both of those areas. So real estate and hospitality, and particularly in construction. As you move into construction, and these are things that people don't even consider when you look at a use of funds and you say, oh yeah, they're going to go with a wood build. Why wouldn't they do steel? And then, or maybe they're going to go steel, and you're thinking, why wouldn't they go wood? It's so much cheaper. Have a look at your insurance costs. If you get a bid and a quote for doing something in steel versus wood, it's significantly different. And those are things that impact your bottom line. So, and then the nature alone of the insurance and what it will cover is also something that needs to be considered. So it's for us, we have advisors that help us select insurance.
Yeah.
And it's really around, and it's individual to every single project. Sometimes we get some autonomy in that, and other times it'll be up to our lender. They'll be, beyond hazard insurance.
Yeah.
They will be very specific about what type of insurance and the amounts that are required. Not something to be treated lightly. You think you're sitting on a property and it's, a project. We've got a vacant retail building, for example. It's going to be vacant for at least a year while you go through these processes. And, one day out of the blue, my daughter gives me a call and she said, hey, she doesn't call me. She texts me and she said, hey, isn't this your project? And sure enough, there's a car on fire behind the darn project, and her girlfriend had taken a picture as they drove by. So you think, okay, if that building built down, it's vacant, not a big deal. Well, it is a big deal because now somebody who is a buyer for that might want to rent out that retail space, and that has got value. And so now you could have devalued that property because it may have caught on fire and burnt to the ground. Well, you want to ensure that there is going to be some type of dwelling on there that can be income producing if that's what you had before. So it's one small example of how important different types of insurance is. And, from multifamily, right? Get insurance in case your tenants, like if something happens to that property and you can't have tenants in there, you want the insurance that will cover the rent. I mean,
lost wages, rent, lawsuits. I mean, we've had 2 fires this year alone. 2 fires, 2 floods. I mean, people live in it. What do you expect?
Oh, yeah, and even if they don't, right? It's been vacant.
Arson, yeah.
And then you get people who live behind it or something, and nobody plans an accident. That's what insurance is for.
Right. So I guess bottom line, same thing, is it's definitely still a part of your team and very part of everything that you're doing in hotel development as well. Okay.
But very specialized. So I wouldn't, and in fact, there's some, like if you go for hazard insurance, for example, some won't even touch this, right? So they're like, no, we don't insure that type of asset. This is not something you can get. And so you need to understand who to go to in an industry that's very good at what they do and is going to perform the way that you're expecting. So your interpretation of your policy matches theirs.
Exactly.
That's also very important.
And then also matches your lender's requirements. Like you mentioned earlier, for us, when we do Fannie Mae, Freddie Mac loans, they definitely have certain requirements for safety, certain requirements for, like you kind of mentioned, the insurance coverage, which is also basically safety. Could you speak a little bit to what typical or what kind of lenders are you working with? In multifamily, it's Fannie, Freddie, CMBS, so like mortgage-backed securities, and then also bank debt if it's more unstabilized. So those are the kind of projects that I've made a bunch of money on, where it's like, okay, well, we can't get a long-term loan, low interest, very, very stable, I guess, loan, if you will. It's more of a high-risk loan, so they'll do a shorter term, higher interest rate, certain things like that until we get it. We get the project stabilized, and then we can flip into the longer term loan. Is it similar to that in hotels, or is there a whole different loan category that are typical? How does that work?
Okay, so for us, and I don't think we're that much different from anybody else, but we call it the loan of Tom, Dick, and Harry. So we will leverage hard money loans, and a lot of times it's because conventional is just not going to. They're going to take too long when we're trying to get the acquisition done, or the properties won't appraise for what they think. They just don't see the future value. There's no accounting for that future value.
Yeah.
That's a very hard sell. So I probably have about 30, 35 sources, and of those, I'm going to say 8 are money brokers, and you need to be very careful when you're going into these deals that the terms that you're going to be stepping into that you can live by. So rate is one thing, obviously. If I'm offering my investors 20-25% annualized returns for purchasing shares in the company, but my hard money loan is 10%, I'm going to maximize as much hard money as I can get. And 10%, some people are probably sitting back going, you're going to pay 10? Well, I'm prepared to pay 25 because I know that there's enough lift in that project value. There's profits there. I don't need to be greedy. I need to, I want to have the project be successful. So, so what I look for when I'm looking at a term sheet in hard money in particular, so one, how do I feel about that initial interaction with this person? Because generally it's an individual. They may represent an institution, but at the end of the day, it's that initial interaction. What does their paper look like? What are they asking me for? Are they a complete disaster organizationally, or are they professional? If they're organized, then, if I run into problems later and I need to have a professional discussion, I want to have it with a professional. I don't want to have it with somebody who's threatening to break my legs. So, and then I want to look at terms. Am I got enough time? Do I have an extension available to me? Do I have to pay for that extension? Do I have to apply for that extension, or is it automatic? Am I looking at a balloon payment that can I raise the funds to manage that balloon payment if it happens? And then really, are they going to be using a servicing company, or are they going to be collecting this themselves? Am I Venmoing cash and trying to do it in chunks, or am I just professionally writing them one check and it goes to a servicer? So those are the things that I'm really looking for when I'm evaluating the opportunities to go and leverage hard money. I'm not going to the institutional banks. It's just not going to happen.
Yeah. Good. Okay. So a little bit different, but I mean, we can possibly do that too. It's not unheard of by any means. Now, we've covered that. Now, you used a term twice that I've never heard of before. Can you tell us what a land bank is?
Oh, sure. It really means that you're buying property and holding on to it. It's kind of like putting cash in the bank or cash under your mattress. Folks will seek good opportunities, and they have cash available to them. They know that property is going to appreciate. There's one thing that's always happened in the Silicon Valley, and that has been an increase in value. It's a high barrier to entry market for so many industries. Hospitality is definitely one of those. It still continues to be that way. Even during COVID right now, when I say, okay, we're struggling to find a buyer, the reality is we still had offers. So we just didn't want to take them. Mm-hmm. and that's where you say to your investors, I can take a lower offer today. I can do 9.8 for you, but if we hold, maybe in 12 months, I think we're going to do 13. That's land banking. Yeah. That's holding.
Got it. I appreciate you defining that for us. So I love these interviews because I get to learn something too every time.
So do I.
Really? You're the expert. So being the expert, I guess at a 30,000 foot view, when someone is looking at different asset classes to either invest in or to go take down as an operator themselves. Okay, I want to do mobile home parks. Okay, I want to do multifamily. Okay, I want to do hotels. I mean, there's so many different cash flowing assets that are out there. Why hotel development, or why hotel as a owner operator?
I think that it's market by market. If you've got a market that needs mobile homes, then you're going to chase mobile homes. And also, if that's something that intrigues you. For me, personally, I fell into hospitality and I love it. It's a great industry to be a part of. We're an unusual developer because of our depth of involvement that we get into with the industry. And this is how you do become an expert, is it's not just, hey, I'm a developer. But no, I'm actually, when you ask me what industry I'm in, I will say I'm hospitality. And that's because I attend conferences, I speak at conferences, I'm a continual lifelong learner, so I'm taking credentials, like I completed a owner's certification. I'm involved with the brand level. I'm brand agnostic, so it's not like I'm a franchisee of one particular brand. I get to know all of them, so I have good relationships with the top 10 brands in the U.S., plus one in America, and in Canada, and then another in Europe that want to expand into America. And then it goes further, which is where I actually belong to associations and I sponsor activities where I know owner-operators will be. And I go up to the legislative summits and advocate. I don't lobby because that's a job, but I advocate. I understand the issues that are important in industry, and I'm happy to represent the industry and talk to our assemblymen and give them a voice that they don't have. So why hotels? I mean, part of it is a passion for the industry and a belief in it, and an understanding that I can see that that this is an industry that demonstrates profitability. And when something's profitable as a business person, that's attractive. Yeah. So for me, I'm just looking at what's something that I really enjoy, and then how do I marry that with profitability? Now I've got a beautiful combination. It's the old adage, I'm not going to work.
Right. Right. You get to do something that you enjoy. So that's awesome. I mean, hearing that from your perspective, why hotels? I appreciate that, because I think that's hopefully the question everybody's really wanting to know the answer to. And so that's why I kind of wanted to save it for the end of this interview, and to be able to, leave everybody with something to kind of chew on, after the interview. Well, Miss Shannon, we're right about at the end of our time here. I really appreciate you being able to share so much knowledge with us, and so much insight, to things that like I said, I learned during this interview. And we'll have a few more in the future, and so I may reach back out to you to do some more, if that's okay. But,
yeah, that'd be great, Kaylee. I've loved it. This has been a joy.
Awesome. If anybody is interested in getting involved with your projects, for example, if they're like, I really am involved or want to get involved in hotel development as a limited partner, for example, how can people get in touch with you?
The best way is to just go to our website. So it's www.northstarhoteldev.com. And as I said, we have a sister company as well, which is Northstar Development, which is northstardevgroup.com. Both of those will get you to us. I'm on LinkedIn with a name like Shackerley-Bennett. I'm easy to find. I'm pretty Googleable. And otherwise, Silicon Valley Hotel Developer will probably take you there as well. But we're always delighted to talk to people. And we're looking at a new project on the peninsula in the Bay Area that's about 125 rooms. It's perfect for the business traveler coming into SFO. And we're looking at probably opening a raise for that pretty soon. So it'd be exciting to hear from anybody who's got an interest in that.
Absolutely. Well, Ms. Shannon, I really, like I said, appreciate your time and your insight. Until next time, thank everybody for tuning in and for watching and listening wherever you're coming from to our session with Ms. Shannon. I will see everybody pretty soon. You got it.